Aloha, this is Joshua Hayes at Big Wave Trading for your October 9th market wrap update. As you can see, today was another very ugly day across the board as the S&P 500 dropped 7.6%. The Dow Jones Industrial Average dropped 7.3%, and the Nasdaq fell 5.5%. So it was another ugly day. And another problem with today's sell off, volume once again was nowhere near a capitulatory level, signaling that we're going to be done with this selling anytime soon. I tell you what, about the only thing that we can hope for is for an oversold bounce. As you can look here, we've been down 1, 2, 3, 4, 5, 6, 7 straight days in a row selling off. Weekly charts of the indexes are about as ugly as they get. This is the S&P 500, and nowhere going back to 1994 can you find a week as ugly as this one. This includes the Nasdaq. When you look at the Nasdaq on a long-term chart, you can see that there was a nasty sell-off, obviously, from 2000 to 2002, but nothing like this down 16% week that we're dealing with right now. I don't know what that noise is, but I just had a noise go off. The Dow Jones Industrial Average is the exact same way. As you can see here, you can't find another week where it's down as much as it is, being caught down 18% right now in 1 week. Bottom line, these are extremely ugly charts. And like I keep saying, and if you would have been listening to me all year long, you never would have been long stocks, because you never go long while price is below the white line, the 50-day moving average, and the 50-day moving average is below the purple line, the 200-day moving average. If you look at the whole 2008 year, you can see that prices never ever got above the 250-day moving average the entire year. So if you would have cut your loss with the death cross back in December, you could have saved yourself a painful 35% drop alone in the Dow Jones Industrial Average. Now let's go look at the Nasdaq. The Nasdaq shows the same thing. It could never hold above the 50 and 200-day moving average, and the 50-day moving average hasn't been above the 200-day moving average since the beginning of the year in January. So if you would have listened to it from that death cross right there, you could have saved yourself 30%. Since the top in October, the Nasdaq has lost 42%. I believe Kramer's down 33%. My worst account's down 7%. So once again, it proves charts do work. Not only do I make a lot of money in bull markets when it's a bullish time and time to be going long stocks, but in bear markets, by just being in cash, a 0% return beats a 42% loss, obviously, if you use your brain and use common sense. But going short was where it was at this year, and even though I wasn't heavily short this year, I still am short 26 stocks, and about 20 of them have given me gains. I can read these off really quick out loud. 58, 39, 17, 40, 42, 39, 43, 60, 41, 18, 42, 60, 58, 43, 17, 30, 45, 31, and 26% gains in some of the shorts that I'm in. And that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. That's 19 of my 26 shorts. So as you can see, being short this year was the right way to go. Now, at the same time, a lot of people see that there's a lot of fear in this market. In fact, the VIX is at 63.92, an area that I know that it has not seen since 1987. So it's amazing that the VIX is this high, yet we have no capitulation selling volume, which means that volume is the highest we've ever seen it ever. Or even if volume's the highest in the past 3 years, I'll take that as capitulatory volume. But there's definitely nothing to look at. This CBOE OEX VIX is hitting 75, and as you can clearly see here, that level hasn't been touched since 1987. So, and the CBOE NASDAQ VIX is still not at its highs in 2000. In 2001, when it hit 89.55, and then in 2001 hit 91. So it can hit the 90s, and this one's only at 70. So maybe we need the CBOE NASDAQ Volatility Index to hit the 90s before we see decent bottom, I guess. To be honest with you, I'm not even looking for a bottom anymore because there are so many things telling me that we can continue to get oversold that I'm not too worried about it. But I mean, if you look at the New York Stock Exchange, look at that. Look at the Russell 2000. Look at that. The small cap 600, the NASDAQ. I mean, it doesn't matter what you look at. It's extremely ugly. Now, I believe since the top in 2007 to now, the S&P 600 is only down 38%. So the NASDAQ looks to me like it's the weakest one. I'm not too sure, but I mean, a 40% drop since in 1 year is amazing. And the funny thing is if people would just wait till the price is above the white line and the white line is above the purple line before going long, they would realize that that's the only safe time it will be to enter the market. If you look at 2003, you'll notice that the index rallied the entire year with the price above the 50 and 200-day moving average. When it went below the 50-day moving average, it always found support at the 200-day moving average. Here it's the opposite. Every time the market rallies, it finds resistance right at the 200-day moving average, signaling that this is not a market that you want to be buying stocks in. And with the NASDAQ down 42% since October 31st, 2007, I think that makes it clear that we've fallen a lot, but nowhere near capitulatory volume, because even though the volume bars are high, we would need to see volume trounce all of this in 2000, 2008 before I could call a bottom. I'll show you some of the stocks I'm short for big gains, like POT and Moss and SBAC, and just show you by getting it on the breakdown to the lows. Look at how quick the 58% gain was. From September 5th to October 9th, I gained 58%. So that's a 58% gain on the short side in 1 month. Folks, charts work. The trends are your friend. Stocks are not going to rise until the earnings per share and sales turn around from this downturn. So it could be 1, 2, or even 3 years before we rally again. I continue to look for stocks to short, and that will be where I'm basically going to focus on. So